Okay, let's unpack this. There's this universal human desire, isn't there? This like deep-seated urge to know what's coming next, especially with the economy and markets.
Absolutely. Yeah, we're all looking for that shortcut maybe, or some
Yeah.
kind of oracle in a world that feels incredibly complex.
We crave predictability, looking for signals, hoping for an edge, or maybe just a bit more certainty when things feel so uncertain.
It feels so intuitive, I think, to look at the giants, people like Warren Buffett, Berkshire Hathaway. I mean, that track record, the sheer scale of the operation.
Yeah, you see those huge positions, you hear whispers about their moves, that absolutely staggering pile of cash. It just feels like if anyone has a handle on the big picture, the macro stuff, it must be them.
Like trying to peek at the smartest kid's answers during a really tough exam, that kind of feeling.
Exactly. And that impulse is completely understandable, right? Berkshire's success demands attention, and their size means, well, eventually we see what they're doing.
Right. And you, our listener, you've brought us sources that dig specifically into this exact question. Is watching Berkshire Hathaway the ultimate macroeconomic crystal ball?
Or if it's not, what does a more, I guess, reliable or systematic approach actually look like?
That's the core question the material we're exploring today really tackles.
Okay. So our mission for this deep dive is to unpack this source material. We'll critically look at this idea of using Berkshire as a real-time macro signal.
See why that intuitive shortcut maybe isn't quite what it seems.
Right. And then build up this comprehensive, multi-layered framework for macroeconomic signal generation that the report presents. We want to pull out the most important insights and, practical takeaways you can actually use.
Yeah, it's about understanding the limits of what seems like an obvious signal
Yeah.
and then discovering a more sort of evidence-based system.
We're going to go on a bit of a journey here. We'll find out why watching Berkshire isn't the real-time predictor you might hope for.
Dig into the details behind that truly massive cash pile. What was it? Nearly $348 billion as of Q1 2025, according to the source.
Incredible number. And then reveal the systematic framework built on tracking smart money, measuring market emotion, the contrarian indicators, and grounding it all in time-tested bedrock economic data.
We'll also touch on the real-world challenges, because forecasting's never easy, right?
Definitely not. And offer some concrete steps for putting this structured approach into practice, stuff that comes straight from the report's actionable guidance.
Think of it as moving from trying to find one perfect signal, which probably doesn't exist, to building a more robust dashboard of complementary insights.
So consider this your fast track to getting well-informed on this topic, quickly, efficiently, getting those key nuggets from the material. Let's get started.
Okay?
Let's start with this idea of the oracle signal from Berkshire Hathaway. It just feels so natural to watch Buffett and the team, especially when those quarterly filings come out.
Yeah, but the source material walks through why this intuition, while it feels right, doesn't actually work as a useful, real-time macro forecasting tool.
Okay, how so?
Well, first, it looks at Berkshire's portfolio itself. As of Q1 2025, their public equity holdings were around $258 billion. Analyzing those does give you insight, but into their long-term view on specific companies or sectors.
Right. It's a long-term value approach, often very concentrated in a few key areas.
Exactly. Like those huge, long-held stakes in financials, Amex, Bank of America, even with some recent BOFA trimming.
The source sees those as showing a core belief in the sort of enduring strength of the U.S. financial system and the American consumer, right? Especially that resilient, maybe premium consumer base that Amex represents.
Precisely. And their big positions in energy, like Chevron and Occidental, that's just a long-term view on global energy demand or maybe just a value play assets they think are cheap.
They've also got classic defensives like Coca-Cola, Kraft Heinz businesses that tend to do okay regardless of the economy, plus some newer consumer discretionary plays like Constellation Brands.
But the key point the source hammers home is that these are investments in specific businesses based on fundamentals, competitive advantage, management quality.
So recent moves like getting out of Citigroup but keeping BOFA, those are company-specific calls, not big macro bets on the whole economy.
Exactly. They're granular judgments, not necessarily broad economic forecasts.
Okay, but what about the cash? That huge cash pile. That's the thing everyone points to. The source says nearly $348 billion in cash, equivalents, and short-term treasuries in Q1 2025.
Yeah, that number gets a lot of attention.
And Berkshire's been a net seller of stocks for, 10 straight quarters, selling over $174 billion more than they bought. That has to mean something, doesn't it? People see that and think Buffett sees a recession coming. He's battening down the hatches.
It is a signal, definitely. But its meaning is often misinterpreted. The source is very clear here.
How so?
Well, Buffett himself has been pretty explicit. The main reason for piling up cash is the difficulty in finding large-scale acquisitions or stocks at attractive prices.
Ah,
He's quoted saying they won't spend unless the opportunity has, quote, very little risk and can make us a lot of money.
so it's less forecasting economic doom and gloom and more just a reflection that market valuations are too high for his liking. It's a valuation signal.
Precisely.
Yeah.
That's the core message. When the world's most famous value investor is holding cash yielding, relatively low rates instead of putting it into stocks, it's a powerful statement that assets, in his view, are generally overvalued.
Right.
The source notes this lines up with broader market metrics, like the high Shiller PE ratio. The cash pile is more like a war chest, waiting for opportunity, and maybe a defensive stance against a market offering poor future returns.
Yeah.
That might coincide with a recession, but it's not a direct prediction of one. It's about opportunity cost and valuation.
This brings us to what the report calls the Buffett paradox. This feels really key.
Yes, absolutely. And this is kind of the central philosophical problem with using Berkshire's trades for macro forecasting. Buffett has consistently, explicitly rejected economic forecasting and market timing his entire career.
Right. Didn't he say something like, the only value of stock forecasters is to make fortune tellers look good?
Yeah. Yes, that's the one. That sounds exactly like him. So his whole fundamental investment approach is actually against trying to time the market or predict the economy.
He builds value from the bottom up, looking at individual companies, not making top-down macro calls.
Absolutely. It's fundamentally long-term, bottom-up,
Yeah.
intrinsic value, competitive moats, quality management, buying at a fair price. Any macro signal you might try to read from his actions is really just an unintentional side effect of applying this strict value filter.
So if he can't find companies meeting his criteria, the result looks like caution, but it comes from that bottom-up process, not a top-down prediction.
Exactly right.
Okay, so the philosophy doesn't fit. The cash is more about valuation. But even if we ignore the philosophy for a second, there are just practical problems with the data itself, aren't there? Like the 13F filings everyone watches.
Yes, Section 1.4 in the source covers this, and it's really critical. Relying on 13Fs for timely macro signals is basically structurally impossible because of the reporting rule.
Why is that? What's the lag we're talking about?
The SEC requires these big managers to file Form 13F within 45 days after the end of each calendar quarter.
45 days after the quarter ends. Wow. So a trade made right at the start of a quarter.
Huh.
It might not be public knowledge for up to 135 days later, the whole quarter plus 45 days?
Exactly. 90 days in the quarter plus that 45-day lag, it makes the data fundamentally historical. It's not a forward-looking tool for real-time forecasting or making tactical moves. You're always looking backwards.
You are seriously driving by looking only in the rearview mirror at that point. That's way too late.
Precisely. And on top of that, the 13F filing only gives you an incomplete picture anyway. It only shows long positions in U.S.-listed stocks. Some options, convertibles. It doesn't show any short positions. It doesn't show international holdings like Berkshire's big stakes in Japanese trading companies. Those are not in the 13F, or private companies, real estate, commodities.
Oh, wow. So you might see them holding a stock and think, okay, they're bullish on this sector. But you'd have absolutely no idea if it's part of some complex hedge with a short position somewhere else that you just can't see.
Correct. It could give you a totally misleading view of their actual market stance.
That seems like a massive blind spot.
It is. Plus, the filings don't tell you why a trade happened. Was it profit-taking, tax reasons, diversification, or did they genuinely turn negative on the company? You just don't get the context.
And the source even mentions reliability issues with 13F data that the SEC itself acknowledges and suggests that maybe the really valuable short-term trades might happen and be closed out within that 45-day lag so they never even show up.
That's right. So, yeah, analyzing Berkshire's portfolio is interesting for understanding their long-term strategy, maybe academically. But relying on 13Fs for real-time macro prediction, it's built on stale, incomplete, context-free data that actually contradicts the investor's own philosophy.
Okay, message received loud and clear. The intuitive dream of watching Buffett's 13F for tomorrow's market move is officially busted. It just sounds fundamentally flawed because of the lag, the missing data, everything.
Pretty much, yeah.
So if relying on a single delayed source like Berkshire isn't the answer, what does the source material suggest is a more reliable, more systematic way to try and anticipate these big macroeconomic shifts?
Okay, that's where Section 2 comes in. The idea is that a more robust method involves creating a composite signal, pulling from a diverse set of indicators across different parts of the market and the economy. The framework proposed in the source is built on three distinct but complementary pillars.
Right, I see. And the first pillar is tracking what they call smart money signals, the moves of informed capital.
Yes, exactly. This looks at two key groups who, at least theoretically, have better information or insight than the average investor. First, institutional investors.
Okay.
Their collective fund flows, basically, where they're moving large chunks of money, can be a real-time gauge of professional risk appetite. Big, sustained shifts, say, out of stock funds into safer money market funds or bonds, that can signal that the pros are getting nervous.
Like a broad risk-off signal playing out.
Exactly. And the reverse is true. Too strong inflows into equities suggest a more bullish risk-on stance. You can track this data from various places like Morningstar, the ICI, even the Fed's Flow of Funds report. The key is looking for significance, sustained rotations, not just daily noise.
Makes sense. And the second group within this smart money category is corporate insiders. The execs, directors, big shareholders.
Right. These are the people who really should know what's happening inside their own companies. They've got the most intimate knowledge of the firm's prospects.
And there's evidence this matters.
Yeah, academic studies, including some mentioned in the source from the NBER, have shown that aggregate insider trading activity, especially the ratio of buys to sells, can have some predictive power for future market moves. But there's a really crucial distinction to make here.
Okay, what's that? Not all insider trades are created equal.
Precisely.
Yeah.
They're not all equally informative. You need to focus on what the source calls opportunistic trades, not the routine stuff like scheduled sales for diversification or just exercising options. The emphasis is on finding high-conviction transactions.
High conviction. Okay, what does that actually look like if you're trying to track this? What are the signs?
Well, it's things like cluster buys. That's when multiple insiders of the same company are buying around the same time. That looks like shared confidence.
Okay.
Also, look for purchases by the top executives like the CEO or CFO because they have the broadest view. Large volume purchases signal real belief, putting significant skin in the game.
Right.
And importantly, insider buying is generally seen as a much stronger positive signal than insider selling is a negative one.
Why is that?
Because there are lots of perfectly normal reasons someone might sell stock needing cash, taxes, diversification. But there's usually only one really compelling reason to buy your own company's stock on the open market. You genuinely think it's undervalued and going up.
Okay, that makes a lot of sense. So track the informed money, but with nuance. Focus on those high conviction buys from the key players inside the company. Got it. What's the second pillar in this framework?
The second pillar is what the source calls the contrarian's compass, basically, measuring market emotion or sentiment. This isn't directly forecasting the economy itself, but it gauges the collective psychology of everyone in the market to spot moments of extreme feeling.
Extreme fear or extreme greed, which often happen near market turning points. The old adage of buying when there's blood in the streets, selling when everyone's popping champagne.
Exactly that. The source highlights two main ways to measure this. First, investor surveys, like the AAII Sentiment Survey, which polls individual retail investors about whether they're bullish or bearish.
And the key is using this in a contrarian way.
Yes, that's where the power lies. So if retail investors are extremely historically bearish, like everyone thinks the sky is falling, that could actually be a strong signal to buy.
Because the fear is likely overdone.
Right. Extreme bearishness, say, when the bull-bear spread is way below its historical average, often signals widespread fear, maybe capitulation. Most people who are going to sell have probably already sold, which can set the stage for a market bottom. And conversely, extreme bullishness suggests complacency, which you often see near market tops.
Okay. And the second way to measure sentiment is using market-based indicators, the fear gauges.
Yes, these are arguably more objective because they come directly from trading activity. The most famous one is the VIX index, the fear index, measuring expected volatility from S&P 500 options prices.
How does that work as a contrarian signal?
Well, a sharp spike in the VIX, let's say it jumps decisively above 30 or even 40, that indicates panic. It often coincides with market lows, suggesting a potential contrarian buying opportunity might be near. On the flip side, a very low VIX, maybe below 15, suggests complacency, maybe too much optimism, and potentially a higher risk of a market correction.
And the put-call ratio, how does that fit into this emotional picture?
That indicator compares the trading volume of bearish put options to bullish call options. So a high ratio, generally above 1.0, means bearish bets, puts, are dominating bullish bets, calls. It's another sign of widespread pessimism that a contrarian might see as a potential buy signal. A low ratio suggests the opposite may be excessive bullishness.
Got it. So pillar one, smart money tracking formed moves. Pillar two, contrarian indicators measuring emotional extremes to spot potential inefficiencies. What's the third pillar?
The third pillar is the bedrock indicators. These are the classic time-tested economic signals that have a proven history of leading the business cycle. These are the big macro data points you often hear about in the news.
Okay, so these are tied directly to the health of the actual economy, not just market sentiment or flows.
Exactly. And the source highlights several key ones known for their strong leading properties. The yield curve is arguably the #1 recession predictor discussed in the material.
Yeah, we hear a lot about the inverted yield curve. What exactly is the signal there?
Right, so the yield curve just plots bond interest rates across different time horizons or maturities. Normally it slopes upwards, you get paid more interest for lending money for a longer time. Makes sense.
Sure.
An inverted curve is when short-term rates actually become higher than long-term rates. This signals that the bond market, which is often seen as pretty smart money itself, expects a significant economic slowdown ahead, forcing the central bank to cut interest rates in the future.
Which specific curve inversion matters most, according to the source?
The source specifically points to two key spreads: the 10-year Treasury yield minus the 3-month Treasury yield, and the 10-year minus the 2-year Treasury yield. A sustained inversion of the 10-year 3-month spread, in particular, has preceded every single U.S. recession since 1960, with only one false positive along the way.
Wow. Okay, that is a stat you really can't ignore. Every recession since 1960, one false positive. That's incredibly powerful.
It really is.
What else is in this bedrock category of leading indicators?
Purchasing Managers' Indices, or PMIs. These are timely surveys of businesses, both in manufacturing and services. They ask about things like new orders, production levels, employment, inventories.
How do you read those?
It's pretty straightforward. A reading above 50 indicates the sector's expanding. Below 50 means it's contracting. What's really useful is the direction of travel, the momentum, and especially the forward-looking new orders component. That can be a strong leading indicator for GDP and overall economic activity.
Makes sense. And what about the labor market? That feels crucial.
Absolutely. Initial jobless claims. This is a weekly report, very timely, showing how many people filed for unemployment benefits for the first time. A sustained upward trend in the 4-week moving average is a classic warning sign of a weakening labor market and typically precedes a broader economic slowdown.
Okay. And finally, the housing market often leads the economy too, right?
Yes, building permits. It's a key component of the Conference Board's official leading economic index, actually. The number of new residential building permits issued is a signal of confidence in the future builders' and buyers' willingness to commit capital to long-term projects. A sustained decline in permits is often an early warning sign of a broader slowdown, reflecting falling confidence and reduced investment.
Okay, so we've got these three distinct pillars. Tracking smart money for informed flows, measuring market emotion with contrarian indicators, and monitoring these classic bedrock economic leading indicators. But, I mean, that's a lot of different signals across those categories. They might not all point the same way at the same time, right? How do you actually synthesize all this into something coherent and useful?
Yeah, that's the big challenge, and it's addressed head-on in Section 3. Just monitoring a bunch of disparate indicators individually is necessary, but the real value comes from pulling them together into a coherent view of the macro landscape. This needs a structured approach to cut through all the noise.
The source mentions building some kind of composite view, maybe an index?
Yes, aggregating indicators can definitely provide a clearer picture than staring at a dozen separate data points. The tricky part is how you weight each indicator appropriately. The source talks about different methods, simple, equal weighting, more complex statistical approaches, but also warns about the risks of, over-optimizing or overfitting to past data.
Right, you don't want a model that only works on history. So what's the practical recommended approach suggested in the report?
It leans towards a hybrid model, using a degree of expert judgment, but within a structured, tiered warning system. This prioritizes indicators based on their historical reliability and their theoretical importance. But the real power, as the source emphasizes repeatedly, comes from watching for the confluence and sequence of signals across these different layers: financial markets, business activity, labor market.
Okay, so when signals from different areas start telling the same story, that's when you pay attention.
Exactly. That provides a much more robust forecast than relying on any single indicator in isolation.
Okay, let's dig into the specific tiered system the source proposes. There's a Tier 1 red alert, What exactly does that signify?
This is designed to be the high-conviction recession signal. It's meant to warn of a high probability of recession hitting within the next, say, 6 to 18 months. It uses the two most historically reliable long lead indicators discussed in the material. The signal here should really prompt a strategic review of your long-term portfolio risk.
Okay, high conviction, long lead time. What's the specific rule? What actually triggers that red alert?
It gets triggered only when both of these conditions are met. First, you need a sustained inversion of the 10-year, 2-year Treasury spread. That means it falls below zero and stays there for, say, more than a month. It's not just a brief dip.
Okay, condition one. Sustained 10Y2Y inversion. What's the second?
Second, the 6-month annualized growth rate of the Conference Board's leading economic index, the LEI, falls below its official recession threshold, which is -4.1%, and its diffusion index, which measures how many components are falling, drops below 50. So you need both of those heavy hitters flashing red simultaneously.
Got it. A strong signal from two really critical, historically validated indicators. Okay, what's tier two then? The yellow alert.
Tier 2 provides more of a medium-term assessment of economic momentum, looking at things on maybe a monthly to quarterly basis. It acts as kind of a confirming layer for any Tier 1 signal that might be flashing. It's based on a simple dashboard scorecard.
A scorecard? How does that work? What indicators feed into it?
Okay, so each month you assign a score. +1 for positive, 0 for neutral, or -1 for negative to several of the indicators we've discussed. Things like the PMI composite, so manufacturing and services combined below 50 is negative. The aggregate insider buy-sell ratio, sustained net selling is negative. Institutional fund flows, sustained outflows are negative. The initial jobless claims 4-week average, a sustained rise is negative. And building permits, a sustained fall is negative.
And how do you interpret the total score from that dashboard?
A consistently negative aggregate score, say, it adds up to -2 or lower for maybe 2 or 3 months in a row, that indicates that economic headwinds are really gathering steam. It increases the conviction behind any Tier 1 red alert. It's confirming the slowdown seems to be broadening out across different areas.
Makes sense. It adds confirmation. And finally, tier three.
Tier 3 is the tactical signal. Now, this one isn't for forecasting the economy itself. It's specifically for identifying potential market entry or exit points driven by those emotional extremes we talked about earlier.
Ah, okay. So the contrarian indicators really come into play here for trying to time market moves, not necessarily predict economic shifts months out.
Exactly. So there's a contrarian buy signal triggered by extreme fear. That happens when 2 or more conditions are met. Maybe the VIX spikes above 30, and the AAII bull-bear spread is deeply pessimistic. The example used is less than -20%. Or the put-call ratio is really high, say above 1.2. This suggests widespread panic might have created a tactical buying opportunity.
Okay, extreme fear, potential buy signal. What about the other side? A contrarian sell or maybe just a caution signal?
Triggered by extreme greed. Again, when 2 or more conditions line up, like the VIX is very low, maybe below 15, and the AAII bull-bear spread is super optimistic, maybe plus 20%, or the put-call ratio is unusually low, say 0.7. This warns that complacency might be widespread and the risk of a pullback or correction could be elevated.
This whole structured approach, with the tiers and the specific rules, it really makes a lot of sense for trying to bring some order to all this data.
Yeah.
But forecasting anything, especially the economy, it's never easy. The source talks about navigating the noise and potential pitfalls, right?
Absolutely. You have to go into it understanding the limitations and the challenges. A really big one is data revisions. Those initial economic data releases we see, they're often just estimates, and they can get revised significantly later on, sometimes changing the picture quite a bit.
Yeah, I've seen that happen.
The example in the source about the job losses back in the 2008 crisis really drives this home. And an initial report showed 159,000 jobs lost, which is bad, but it was later revised dramatically higher to 403,000 lost. Huge difference.
Wow. So the takeaway is don't overreact to a single data point release.
Exactly. Look for trends, wait for confirmation across multiple indicators. Don't jump to conclusions based on one potentially noisy or soon-to-be revised number.
And then there's the perennial pitfall, the one that seems to sink so many investors, trying to perfectly time the market.
Oh, absolutely.
Yeah.
The framework is designed to inform strategic positioning and manage risk, definitely not to enable perfect market timing. The source echoes tons of academic studies and historical data showing that trying to jump in and out constantly is generally a losing game for most investors over the long run.
Why is that again?
Well, trading costs add up, taxes can be a drag, But the biggest risk is missing the market's best recovery days. Those often happen really quickly and unpredictably right after the worst days, and if you're sitting on the sidelines, you miss out on a huge chunk of long-term returns.
So it's not about being a fortune teller calling the exact top or bottom day,
Not at all.
but more about using a structured process for disciplined risk management as you move through the economic cycle.
Precisely. And the source connects this back to that tension between the efficient market hypothesis, the idea that all known information is already baked into prices, and behavioral economics.
Yeah.
While markets are mostly efficient, those human biases we all have, herd mentality, fear of missing out, FOMO, loss aversion, they cause these periods of irrationality. They create the very emotional extremes that the contrarian signals are designed to identify and potentially exploit.
Ah. Okay, so the framework helps you capitalize on predictable patterns of human behavior, not just cold economic data. It helps you see when the crowd might be getting carried away one way or the other.
Exactly. And the source suggests that maybe the biggest challenge isn't really mastering all the indicators themselves.
It's something even harder.
Yeah. It's often overcoming your own biases. Those deeply ingrained human tendencies that urge to jump in when everyone else seems to be making easy money, the fear that paralyzes you when prices are dropping, just the inability to act when things feel uncertain. This structured framework is presented as a key tool for imposing that necessary discipline on yourself.
Okay, so how does someone actually take this framework and, put it into practice? The report doesn't just leave it at theory, right? It gives a kind of practical to-do list.
Yeah. Yes, absolutely. It translates the analysis into concrete, actionable steps. Step one is basically building your data dashboard. You need to centralize how you monitor these key indicators so you can see everything easily in one place.
What kind of tools does the source suggest for doing that? Is it complicated?
Not necessarily.
Hmm.
The source suggests options depending on your technical skill and resources. For beginners, even free financial platforms like TradingView or Investing.com let you create custom watch lists with these key indicators and assets.
Okay.
For intermediate users, maybe a simple spreadsheet pulling data from free sources like the FRE database, that's the St. Louis Fed, allows for more customization and maybe some basic calculations. And then for advanced users, if you have programming skills, you could build a fully custom dashboard using something like Python.
Right, so get the data organized and visible. What's step two?
Step two is setting up an alert system. This is really crucial because it moves you from having to constantly check everything, which is tedious and easy to miss things, to being passively notified when a key signal or threshold you've defined is actually triggered.
Automated alerts based on the rules from the framework.
Exactly. Use calendar functions on financial websites or maybe in your brokerage account to get reminders for important monthly data releases, the LEI, PMIs, that kind of thing.
Yeah.
And crucially, set up indicator-level alerts on platforms like TradingView, or maybe your broker offers them, or specialized data providers. You want alerts for when specific indicators cross those critical thresholds we talked about.
Like setting an alert for when the 10-year minus 2-year spread actually goes below zero and stays there for a week or two, or when the VIX spikes above 30.
Precisely those kinds of things. Or setting an alert when the AAII bull-bear spread drops into that really pessimistic zone. The source even mentions how you do this on professional terminals if you happen to have access to those.
Okay, great. So data centralized alerts set up so you know when something important happens according to the rules. Step 3 is the execution protocol, making a plan.
Yes. This is all about translating those signals into potential actions in a disciplined, rule-based way. The whole point is to try and remove emotion from the decision-making process when things get stressful in the market. The source provides a simple, repeatable checklist and an if-then structure for this.
All right, there are weekly and monthly review checklists. What do they involve?
Yeah, just a brief weekly check on the faster-moving data, like initial jobless claims and the AAII sentiment survey, things that come out frequently. Then a more comprehensive monthly review, probably after the major data releases like LEI and PMI come out. That's when you check the yield curve, LEI, PMI, insider activity, fund flows, building permits, and you update that Tier 2 yellow alert scorecard we discussed.
Got it. And then the if-then action scenarios. This is where the signals might actually lead to portfolio adjustments.
Exactly. This is where you predefine your potential responses so you're not making impulsive decisions under pressure. For example, if the Tier 1 red alert is triggered, that's the 10Y2Y inversion plus the LEI drop, then the plan says, conduct a strategic portfolio risk review.
What might that involve?
It might mean, for example, reducing exposure to highly cyclical sectors that get hit hard in recessions and maybe increasing positions in more defensive sectors, or perhaps high-quality, longer-duration bonds.
So it's not necessarily liquidating everything, but a strategic shift to lower risk based on a strong warning signal.
Right. Another example, if the Tier 2 yellow alert dashboard is consistently negative for a few months, then the protocol might say, increase caution. This could mean maybe holding off on making new aggressive investments, reviewing existing higher risk positions, and maybe trimming some, perhaps building up cash reserves a bit more strategically.
Okay. What about the tactical signals? If the Tier 3 extreme fear signal hits, VIX spikes, sentiment tanks?
Then, the protocol suggests viewing it as a potential tactical buying opportunity. The source suggests deploying capital systematically, maybe not all at once, into long-term positions, like broad market index funds or quality companies that look like they've been sold off irrationally in the panic. Basically, buying when others are terrified, as the saying goes.
And the flip side, if it's the extreme greed signal, low VIX, euphoric sentiment.
Then the protocol says view it as a signal to manage risk proactively. This might involve rebalancing your portfolio, trimming positions that have grown overly large after big gains. And, crucially, actively resisting that FOMO, the fear of missing out, which tends to be rampant near market tops when valuations get stretched and everyone feels invincible.
So it really is a structured step-by-step process, from getting the data together to getting alerted when key thresholds are crossed to having a predefined rule-based plan for potential action, all based on this multi-pillar framework.
Exactly. It's designed precisely to try and impose discipline and provide an evidence-based system for navigating market cycles, rather than just relying on gut feelings or trying to follow one single, potentially flawed signal like the Berkshire example we started with.
We have certainly taken a deep dive into the source material today. We kicked off exploring that very intuitive idea, the one lots of people have, of watching Berkshire Hathaway as some kind of macroeconomic signal.
Yeah, only to find that despite the company's incredible success and appeal, it's ultimately flawed as a real-time macro forecasting tool.
We saw why primarily the huge lag in those 13F filings, right? Up to 45 days after the quarter ends, making the data inherently historical, looking backwards.
Right, and the incompleteness of that data too, no shorts, no international holdings, no private stuff, so you never see the full picture.
And maybe most fundamentally, the contradiction with Warren Buffett's own stated value investing philosophy, which actively rejects trying to time the market or forecast the economy.
Exactly. And we learned that the massive cash pile, nearly $348 billion per the Q1 2025 figures in the report, is less about predicting a recession directly.
And more a powerful signal about market valuation, basically saying things look too expensive from his rigorous value perspective.
Precisely. It's a defensive stance against expensive assets, a sign of limited opportunity, not really a crystal ball for timing an economic downturn itself.
So the compelling alternative presented in the source is this structured multi-indicator framework. We explored its three main pillars.
Pillar 1. Tracking informed capital via smart money signals those focused corporate insider buys, remembering why buys are often more telling, and institutional fund flows showing where the big money is moving.
Pillar 2, measuring market psychology with contrarian indicators, the VIX, sentiment surveys like AAII, the put-call ratio, looking for those moments of extreme fear or greed that often signal turning points.
And Pillar 3, monitoring the classic time-tested bedrock economic data. The leading indicators like the yield curve, especially that incredibly reliable 10-year 2-year or 10-year 3-month inversion.
The one with the amazing track record preceding recessions, plus PMIs for business activity, initial jobless claims for the labor market, and building permits for future confidence and investment.
And crucially, the real power isn't in any single indicator, but in synthesizing them, looking for that confluence and sequence across the proposed tiered warning system.
Right. The high conviction Tier 1 red alert, the confirming Tier 2 yellow alert scorecard, and the Tier 3 tactical alerts based on those contrarian emotional extremes.
We also touched on the real-world challenges, data revisions, the danger of trying for perfect market timing.
Reinforcing that this framework is really a tool for disciplined risk management and strategic positioning through the cycle, not some flawless crystal ball guaranteeing you'll beat the market.
Exactly. And importantly, the source didn't just stop with the theory. It gave those practical, actionable steps, the to-do list, for actually implementing the system yourself.
Building the dashboard, setting up the alerts based on the thresholds, and using that rule-based execution protocol with the if-then scenarios to guide potential actions without letting emotion take over.
It shows it's meant to be a system for real-world use, not just an academic exercise.
So, given everything we've uncovered from the source material, the insights into how market inefficiencies can arise from behavioral biases, the need for structure in decision making, the report suggests the biggest hurdle in using a framework like this successfully isn't actually mastering the indicators.
It's something much harder to manage.
Yes. The suggestion is the greatest challenge is often overcoming our own ingrained behavioral tendencies, that herd mentality, the FOMO, the loss aversion, those predictable human patterns that make markets overshoot. So perhaps the final thought to leave you with is this. How can building and, more importantly, sticking to a structured, evidence-based framework like the one outlined here truly help you manage those powerful internal biases and maintain discipline through the market's inevitable, often emotional ups and downs?